Hi, everyone, and welcome to Everything About Wealth, the podcast. This podcast is focused on wealth building, and I am your host, Denny Troncoso. I hope you had a great Valentine's Day with your spouse or significant other. Desi and I did. We had a great weekend. We grabbed dinner, went to a play and saw some interesting and fun short films. We went to our local college. I don't know if you have one in the area. Ours is called Valencia College here in Orlando, Florida. They have some great events, so and all the money goes to support the students and relevant programs, whether it's music, theater, or film. So I recommend you check it out. Now, of course, this is episode number 16. So that's sweet 16 and great timing with Valentine's Day just passing. I want to take all the credit for planning that, of course, but it didn't work out that way. But if you were with us on our last podcast, episode 15, I gave an introduction to mutual funds. And our goal with this podcast, of course, is to help you become a well-rounded investor so you can invest in different areas and go with what is best for you in your particular situation based on your comfort level toward risk. Now, with that, I want to go ahead and say this episode, I'm going to go over this, a show that I went over a few years ago. It's called The Retirement Gamble. And this is a reporter that goes and does some in-depth analysis on the mutual fund industry and on retirement plans and the fees of these retirement plans and how it affects your retirement portfolio. So it's a great episode. I highly recommend you watch the video. But worst case, I'm going to do my best to summarize it for you so you have a good fundamental understanding of everything that's going to be covered. So, of course, as we always say, be ready to take some great notes. And if you don't already, please follow us on Instagram at Denny Troncoso and at Desi Troncoso. And I know Desi has been out for the last couple podcasts. She's been super busy, but she'll be back soon. All right. So with that, let's get going with the show. All right, and to get started, I want to give you a little bit of a background understanding on the retirement plans. So in 1970, 42% of employees in the United States had a pension, basically a guarantee from their employer that's good for a certain percentage of their salary, including benefits for their retirement. So as long as you worked for a certain amount of years, you were set. All you had to do is maybe work 20 years. That was the plan. You work for a union and the employer will take care of you. Now, what happened is that employers planned for life expectancy wasn't going to be 80 years old and even older for some folks. So these pension plans started becoming a problem early as employers had to pay out for a longer estimated time. And they went ahead and tried to change some of these rules. In particular, the rules were changed. Also, global competition. There were new accounting rules. The market was volatile, so the returns for the employers weren't stable enough, so they can continue making the payments. So it went from defined benefit plans where you got a pension, you got a guarantee from the employer and also from the government. Governments have pensions now as well, and that's actually going away. It changed to something called defined contribution plans. And defined contribution plans is another name for something you already know, your famous 401k. Now, the 401k started in the late 70s, early 80s. It was supposed to be something for rich people so they can put money aside. It was a portable, vested amount of money as Americans started changing their jobs more frequently. It was something where also at the same time where businesses wanted to get out of the business of providing pensions and shift the burden to their employees. They wanted their employee to take responsibility. And that sounds good because people should be taking responsibility. There were some challenges with that, and we'll go over some of that detail here. Now, because companies started getting off, removing their responsibility, the employer started taking all of it. The employee started taking all of it. And that's what the 401k does. It puts all the risk on the participant so they can make sure that they have enough money for their retirement. So if you don't plan correctly, you could be in big trouble because it's all up to you now. Now, what happened is the problems is that when you're shifting the responsibility, the people that are assuming that responsibility, they need to have a great understanding or a good understanding of what they're getting into. And 401k meetings were set up to be a bit confusing. If you work at a corporation, the company that handles a retirement plan portfolio comes in and does a day or a few hours of a presentation and of how your account works. And unless you really understand finance, they may go over some of the details, but you really don't know what you're doing and what you're getting into. So they were confusing. The government had created some regulation to protect investors where it gave you the option as an investor to select something that's either aggressive, moderate, or conservative for your investing. So if you wanted to invest, let's say you have 30 years to retire, you need to select a portfolio of stocks, which in the last episode I talked about mutual funds. And you would select the type of mutual fund or several types of mutual fund depending on your comfort level toward risk. So and then this was even more confusing because are you aggressive? Are you moderate? Or are you conservative regarding investing? And this made it very difficult for people to understand. People typically focused on maybe more moderate or conservative investing, right? Because when you don't understand, you just choose what's safer. But in reality, when you were younger, you're supposed to be choosing some of the more growth opportunities, which are under the aggressive category. But to select that, you need to make the choice. The advisor or the company can't make that choice for you. Now, so let's talk about the 3 different types of risks that the employees really took over. And the first one was how much to save. The second was how to invest. So what funds, what allocations. And then the last one is how to withdraw the money to not outlive the asset. So if you do have the opportunity to do things the first 2 the right way, so you invest in the right investment, you invest enough money to put aside $1 million, $2 million, whatever that amount is that you needed to have. Now, how do you organize or plan for that where you're not going to outlive your retirement assets prior to you dying? And then those were risks that the employees didn't have to deal with before, and they had to transition fairly quickly to doing that. And then the industry didn't make it easy. So there was lots of marketing out there from companies that are managing money, and it's confusing. So there's the Fidelities of the world, the E-Trades of the world, and then they're all trying to get your business. And then they have these commercials that are fun and interesting. If you haven't seen the baby commercial and all the other types of commercials out there that are fun and are that's great to get your attention. But what happens is you really don't know what you're doing. You're choosing a company or a fund just because it's the one they're selling, not necessarily because it's the right one for you. So we had on the show, there were quite a few people. One person was Professor Teresa Ghilarducci. She's an economist with the New School. And she said 401ks are one of the only products Americans buy and don't know the price of it. So that's crazy to buy something you don't know what the price of it over time. Well, the mutual fund industry, they've been able to protect themselves from regulation by lobbying the government to expose some of the dangers that would expose some of the dangers and price of their products. So you need to understand how this works. That's the key. The laws may change in the future for your benefit, but right now what I'm trying to do is I'm trying to educate you so you could be prepared and make the right financial decisions for you and your family, because necessarily the government is not going to protect you. It's not set up that way. Industry hopes workers were going to trust an advisor. So the industry hopes you close your eyes and you just let the advisor take direction. But I always believe that you are only as educated as the best advisor in the world. So you need to have a understanding and then go in asking questions and asking why things are being recommended. And then if you have a certain amount of education, then you can actually get better advice. I believe that in so many different areas. So Robert Hilton Smith, an economist. He was a young guy when the show was recorded. The show's probably 10 years ago, this episode. But he started analyzing and doing his dissertation, because he was doing his PhD, on America's retirement problem. So what a great dissertation. So it ended up working out perfectly for him to be a guest on the show. And what he learned were a few things. He had a 50-page prospectus to read for some of the funds, let's say for his retirement, which was confusing. He didn't really understand it. It was more of a disclosure document so the funds could say that they shared all the risk, they shared all the information to the investor, and they were kind of saying that they were home free if something bad happened because they did what they were supposed to do. The average family actually pays, according to Robert Smith analysis, was $155,000 in 401k fees over a lifetime. That's a lot of fees. The system isn't built to benefit individuals. I already talked about that. The average expense ratios he saw were 0.75%, and there were dozens of others that he found. There were fees for taking money from the retirement account. There were fees for asset management. There were fees for marketing, for administrative, for record keeping. There were over a dozen different types of fees that he found after looking at the prospectus. And if you're invested in a mutual fund, whether that be through your 401k or it would be through outside of your 401k, you should definitely take a look at the prospectus and see how much you're paying. This could be a great exercise so you can see what's going on. Now, the average actively managed fund was at 1.3%. The ones that he had options to choose from based on his job. Some charged 2%, and some even charge as high as 5%. So that's 5% in a management fee that you're paying to the company from your investment dollar. So every dollar that you're paying to the companies, that's money that's not staying in your pocket for your retirement, and then that it's not compounding, right? I talked about compounding. I had the Rule of 72 here. This was all planned, right? The Rule of 72, the mutual funds. So you can understand the power of the fees that you're paying, all right? That it's taking away from your retirement, from your family. So annually, it may not be a lot in fees, but as you add it up over a 20, 30-year period, it may be over $100,000. This may be enough for retirement or not, right? So this is an extra $100,000 that could provide cash flow for you on an annual basis for the rest of your life. So there was tons of other fees. There were even something called 12B1 fees that are not paid by the fund company, that is paid by the investor, that goes to brokers and different things. And look, I'll disclose this. I used to be a registered rep, and I used to sell mutual funds. I used to have mutual funds that I would provide to customers. And some of these fees would be paid. But what the key is here is that the fees that you're paying shouldn't be exorbitant. They should be a reasonable amount of fees for the advice that you're getting. So if you're getting, I think I've already had an episode on mutual funds. I talked about what the percentage of fees should be. So you should be in line with that. All right. So everything has a fee, but just be educated enough to find that you're paying what is fair and not more than that, especially for your retirement portfolio. Now, John Bogle, which I also mentioned his book, I believe in the last podcast episode, he founded Vanguard. It's a company that focuses on index funds. And Vanguard offers some of the lowest fee products on the market. He said, he was interviewed for the show, that costs are crucial for the equation, and that the larger profit of a management company, it's the lower profit for investors, right? So if you're paying more to the company, it's less profit for you. Example, 7% fund return. If it's 2% in fees, you lost a third of what you would have had because of the lack of compounded return. So you lost a lot of money just by paying those fees, all right, over time. So the magic of compounded returns is destroyed by the compounding costs. There's 100% of the capital that you're taking 100% of the capital you're putting in, and you're taking 100% of the risk, but then you're only getting 30% of the return. So why are you doing this? right? This shouldn't be intentional. So be aware of how much you're paying. So do a financial calculator. And there should be compounding calculators on Google that you could find and put. If you put in $100,000, and then you have a 1% management fee. Let's say you have no fees. How much would you pay? How much would you have over a 30-year period? And then how much would you pay? How much would you have if you paid 2% in fees? And compare the difference so you could see. John harps on the long-term low-cost investing through mutual funds. He believes that index funds, you can't beat the market with mutual funds. So you just need to use an index fund that copies the market and get Wall Street out of the equation, trading management fees, own American business, and own it forever by indexing. And then the cost of a 1% a year to own, keep your fees below that. And then I talked about that in the last episode. So bottom line, try to focus on index funds, focus on low fees. Vanguard has some great index funds that are low cost, that are some of the most, it's a very popular company. Do your own research. But there's other companies that also have index funds. And some advisors that do recommend index funds, because it's starting to get popular, had a conversation recently with an advisor from Merrill Lynch. And he said, yeah, I like index funds. I recommend them, but I don't like Vanguard index funds for X, Y, and Z. Do your own homework, compare the returns, compare the returns over time, and compare the fees. But index funds is something you should highly consider. Now, in this episode, we also had Phyllis Borsey, Assistant Secretary of Labor. And Phyllis says that anyone can call themselves an advisor. It doesn't really mean anything. It could be a financial planner. It could be a broker. So you really need to, again, be educated and understand who you're talking to. There's an organization that they're certified financial planners. You have to pay a designation fee, and you have to take a certain amount of courses and have a certain amount of education to be part of it. So look for that. And then there's other organizations as well that are similar to that one that can help give you an idea of who you're talking to as well. And then there's also fee-based planners, which they just charge you. They don't sell products necessarily. They just charge you a fee to give you financial advice. So, and then you should ask the people, how are you getting compensated for what the service that you're offering? Then there's something called fiduciary. It says 85% of advisors are not fiduciaries. A fiduciary is a professional by law must put your interests ahead of their own. And then put their interest. That means no matter if they're getting more commissions from something else, if they're a fiduciary to you, then that means that they're going to advise you on what's best for you. And if they don't, they could either lose their license or be financially responsible. Brokers just need they just need to meet a suitability standard for the investment, not a fiduciary standard. So fiduciary is actually at a higher standard. It's not just helping you with an investment to make sure that if you want to invest conservatively, that's what a broker just has to do. A fiduciary actually has to go at a higher level. In 2010, the Labor Department tried to push a fiduciary rule. And just so you understand the laws, the brokerage industry lobbied against it because they didn't want this rule passed, because it was going to make it more difficult for them to do what they do. And this is why, again, you need to educate yourself. The author Helene Olin of Pound Foolish. She explained, the companies that are offering 401ks and matching. She is convinced that executives from these companies really are just convinced that managed funds are better than index funds when they are not, when clearly they aren't, because the data has just been disproved over and over again. But the executives, of course, their financial compensation is tied to the performance of their funds, and then the performance. I'm talking about more people participating in them, not only that they're doing well financially, returning a certain amount of funds for their investors. That's important. I don't want to say, but they need to have investors that are in there so they can get a higher return, so they can charge more fees, etc. And the financial media loves these mutual funds and these executives, especially when they go on the shows and the CNBC and all that excitement. So I'm I'm kind of trying to want you to also, I don't want to say all funds are bad and all media is bad, but I want you to take a step back and be in the right perspective and listen to what other people are saying, but at the same time know where the advice is coming from, and also know if this is if you should just step away from this excitement to think clearly, right? Because sometimes you hear stuff on TV, the market's going up and down, but what is your goals, what is your plans, etc. Now, just to recap as we finish up, I didn't want to hit you too much information with this. I want you to watch the show. But the Department of Labor was trying to enforce a fiduciary rule in 2018. Again, the courts ruled the fiduciary rule was inconvenient to brokers. So because it's inconvenient, they took it out. It's tips. I want to share some tips as well for working with brokers, because there's no more fiduciary rule. So you need to be more informed. Ask people, are you working in my best interests? Clearly ask the question, see what they say. How do you feel about their answer? Ask them, would you be willing to sign a form stating that you will act as my fiduciary at all times with all products? And see what they say. And they should. And if they can't, ask them why. Ask financial advisors for their credentials. I already talked about some of the organizations they should be enrolled with or part of, possibly. Look up potential advisors, what certifications mean that they have with their backgrounds, and what tools they're a part of. The Financial Industry Regulatory Authority has something called Broker Check. So Google that. This shows complaints and years of service for brokers and firms. So this is a great area to check your advisor. Don't just go with somebody because someone recommended them. Do research on them. It could be so many different areas, from a contractor to a broker to anything. Because now you know if there's a complaint, you can also ask the question of why you had that complaint and get an explanation, and then you can decide on if you want to move forward or not. Or also ask for other referrals. Ask for clients that they've been working with maybe 5, 10, 15 years and see how they feel. Ask how much they get paid, how they get paid, and what various fees mean. So if you're paying a certain fee, don't be shy about asking the question, but what does this fee mean? There's a great way to ask the question. Look, I'm trying to understand this. I'm very ignorant to this financial service. So I really want to understand why this fee is being charged to me, or what is this fee for? You're not questioning them. You're questioning the fee. And it's your money that's going to be paid. Know what investment products are being suggested or used and how they are managed. So is it managed by a professional money manager? Is it an index fund? What is the product? What's the name of it? What type of product is it? Is it an annuity? Is it a mutual fund? And then ask why they recommend it, and why would they recommend something different? Is it by age? Is it by financial situation? Is it because of my risk profile? Different things. Research advice, such as look at different organizations and try to read about reputable organizations. Susie Orman, CNN Money, if you Fox Business, Bloomberg Business, all those things. There's tons of articles on fees and financial advice, and read different blogs and listen to podcasts just like this one to get a feel for more information and more understanding on the mutual fund, so you can make a better decision for yourself. Now, with that, I think I probably overwhelmed you enough on the retirement gamble. So I definitely want you to watch the video. It's amazing. I think you're going to definitely enjoy it. It's not very boring. They actually bring some real people in there and they give their stories, which I thought that was very useful. But with that, I'll say thanks for tuning in. I hope you enjoyed the call and understand the retirement gamble, what the basics. I hope you watched the video. If you found the information valuable, please leave us a review wherever you are listening. There's quite a few people that have left us review. Sarah T, we appreciate the review. Groberta and Coco Gavin. So thank you very much for the reviews. We appreciate them, and that allows more people to find the show. And now to learn more about real estate investing or how you can be a capital partner on our next investment opportunity, we're working on some value add projects, multifamily and development projects of multifamily. Visit our website at www.everythingaboutwealth.com. And with that, we'll see you guys on the next show. Take care. Bye-bye.